Insurance is one of those industries most people use their entire lives without ever really understanding how it works. You pay your monthly premium, you hope nothing bad happens, and if it does, you file a claim and wait. But behind that simple transaction sits one of the oldest and most profitable business models in the world. A business built not on selling a product, but on selling a promise. The promise that if something unexpected happens, someone else will help pay for it. Understanding how that promise turns into a functioning industry, how insurance companies actually make money, and why the model has survived for thousands of years, tells you a lot about how the modern financial world is built. The core idea behind insurance is simple. It's the spreading of risk. On your own, a single disaster can wipe you out. A house fire, a serious car accident, a major illness, a lawsuit. But if thousands of people each contribute a small amount of money into a shared pool, that pool becomes large enough to absorb the losses of the unlucky few. Everyone pays a little, and the people who experience the rare bad event get helped by the collective contributions of everyone else. That's the fundamental mechanic. Insurance is not magic. It's math applied to misfortune. The idea is ancient. Thousands of years ago, Chinese merchants shipping goods along river routes would split their cargo across multiple boats so that a single wreck wouldn't ruin any one merchant. Babylonian traders developed early contracts where loans taken to finance a shipment would be forgiven if the cargo was lost at sea. These were the first seeds of what would eventually become modern insurance. The concept grew slowly over centuries, but the version we recognize today really took shape in 17th century London. Merchants, sailors, and ship owners gathered in coffee houses near the docks to make deals. One particular coffee house, run by a man named Edward Lloyd, became the informal meeting spot where ship owners looking to protect their voyages could find wealthy individuals willing to take on a portion of that risk in exchange for a fee. Those individuals would each sign their name on the bottom of a document, underneath a description of the ship and its cargo, agreeing to cover a specific share of the loss if something went wrong. That signature under the risk is where we get the word underwriter. The coffee house eventually became Lloyd's of London, which today remains one of the most influential names in global insurance. The mechanics of an insurance transaction haven't changed as much as you might think since those days. There are still three main players. The client, meaning the person or business buying the coverage. The broker, who helps the client find a policy and negotiates on their behalf. And the underwriter, who evaluates the risk and agrees to take it on in exchange for a premium. The broker typically earns a commission from the premium. The underwriter accepts the risk in exchange for the rest of it, and the client walks away with a promise. A contract that says if certain things happen, the insurer will pay. That chain is the backbone of nearly every insurance product sold today, from shipping policies to life insurance to homeowners coverage. The key question, though, is how insurance companies make money if they're paying out claims to the people who experience losses. The answer is more interesting than most people realize, and it comes down to two things: underwriting profit and investment income. Underwriting profit is the basic math of the business. Insurers collect premiums from thousands or millions of policyholders. They use careful statistical modeling to estimate how many of those policyholders will file claims, how severe those claims will be, and what their total payout obligation will look like. As long as the premiums they collect are larger than the claims they pay plus their operating costs, the insurer makes a profit on the underwriting itself. This is the obvious side of the business, but it's actually the less important one. The real engine of insurance profitability is investment income, and this is the part that most people don't see. When an insurer collects premiums, they don't just sit on that money waiting for claims to come in. They invest it. Because the timing of claims is statistically predictable across a large pool, insurers know roughly how much money they can keep invested at any given moment before they'll need to pay something out. That pool of invested premium money is called the float, and the float can be massive. For a large insurance company, the float can represent hundreds of billions of dollars. That money is invested in bonds, real estate, stocks, private businesses, infrastructure, a wide range of assets that generate returns over time. Warren Buffett famously built much of Berkshire Hathaway's fortune by acquiring insurance companies specifically for their float, using that capital as cheap leverage to fund long-term investments. In many years, a well-run insurance company will actually lose money on underwriting, paying out more in claims than it collects in premiums, and still generate enormous profits because the investment returns on the float more than make up for the underwriting loss. That's the quiet truth of the industry. Insurance companies are financial institutions that happen to sell insurance products. The policies are partly a mechanism for collecting capital at scale to invest. Another mechanism that makes the industry work is reinsurance, which is essentially insurance for insurance companies. When an insurer takes on a particularly large or risky policy, they often don't want to hold all of that risk themselves. So they pass portions of it along to other insurers called reinsurers in exchange for a share of the premium. If a massive claim comes in, the original insurer pays their portion and the reinsurers pay theirs. This spreads risk across the global financial system. A homeowner in Florida who buys a hurricane policy from a regional insurer may not realize their coverage is ultimately backed by reinsurers in Germany, Switzerland, Bermuda, and London. The entire system is a layered web of risk being passed around, priced, and absorbed by entities with the capital to handle it. All of this is made possible by data. Insurance companies employ armies of actuaries, specialists who use statistics to price risk. Actuaries analyze decades of historical data to understand how likely different events are, how much they typically cost, and how various factors affect those probabilities. The age of a driver, the construction materials of a home, the medical history of an applicant, the industry of a business. Every relevant variable is fed into pricing models. This is how two neighbors with seemingly identical houses can pay very different premiums. One might have an older roof, a history of claims, or a credit profile that statistically correlates with higher claim frequency. The pricing isn't personal, it's probabilistic. The insurer isn't judging you. They're placing a numerical bet on the likelihood and cost of your claim and setting a price that allows them to profit across a large pool of similar bets. Claims are where the system becomes real. When something goes wrong, the policyholder files a claim, and the insurer sends an adjuster to evaluate the damage, the circumstances, and the applicable coverage. This is where the relationship between insurer and customer is often tested. A well-run insurer pays legitimate claims promptly, cleanly, and without excessive friction. because reputation and regulatory standing depend on it. A poorly run one can delay, dispute, or deny claims in ways that technically fit within the contract, but leave customers feeling cheated. This is one reason why cheapest isn't always best when buying insurance. The price on the quote matters less than how the company behaves when you actually need them to deliver on the promise you've been paying for. Regulation also shapes the business heavily. Insurance in most countries is regulated at a state or national level, with rules governing how much capital insurers must hold in reserve, how they can invest the float, what they must disclose to policyholders, and how claims must be handled. These regulations exist because the collapse of a major insurer would leave thousands or millions of people suddenly unprotected, and the ripple effects across an economy could be severe. The regulatory framework is one of the reasons the industry has survived so many financial crises, while other parts of the financial system have not. The capital requirements and reserve rules are strict precisely because the product being sold is a promise about the future. What makes insurance such an unusual business is that it sells something intangible. You don't walk away with a physical product. You walk away with a contract. You can go years without using it and feel like you've gotten nothing. But the value isn't in the day-to-day experience. The value is in what happens on the worst day of your year: the fire, the diagnosis, the accident, the lawsuit. On that day, your policy is either the thing that absorbs the financial shock, or it's a piece of paper that doesn't quite cover what you thought it would. Which one it turns out to be depends entirely on what you bought, what you paid, and who you bought it from. That's the modern insurance industry. Thousands of individual policies, pooled across millions of customers, priced by actuarial models, invested through massive financial portfolios, backed by layers of reinsurance overseen by regulators, and held together by the simple original idea that was born in a London coffee house centuries ago. Spread the risk, share the cost, protect the individual by connecting them to the collective. It's one of the most powerful financial inventions in history, and it quietly underpins almost every major purchase, investment, and business activity in the modern world. If you want to go deeper into how this actually affects your own coverage, drop a comment with the type of insurance you're most curious about: auto, home, health, life, or business. And we'll break that one down next.